Good afternoon, everybody. Thanks for coming to this year's AFA lecture. My name is Ulrike Malmendier. I am the president-elect of the American Finance Association and had the honor of organizing this year's program, including one of the highlights is that you get to select who received the invitation and the honor to be the speaker at the AFA lecture. And I was very glad that Nick Barberis, here to my left, said yes, that he would be giving the lecture. I'm just going to say a few words to introduce him, not that he needs any introduction, of course. And after that, hand over to him. The plan is that he speaks for about an hour, maybe a little bit longer, and then we will have time for questions. So we have two microphones to my right and to my left, and given that this is one of the recorded lectures, I would ask everybody who has a question to go to the microphone and ask it from there, please. But let me just take a moment to say a few words about Nick. He's currently the Stephen and Camille Schramm Professor of Finance at the Yale School of Management. And he is a very important person in behavioral finance. He provides a lot of public service to all of us doing research in this area. He organizes the NBR Behavioral Finance Conference. He runs a fantastic program for doctoral students every 2 summers at Yale, a behavioral finance camp. And I'm the beneficiary of having him as a co-organizer for the Behavioral Economics annual meeting, which we have circulating between Yale, Cornell, and Berkeley every year. And I am learning enormously much from the best part of that conference is that I get to discuss submissions with Nick and Ted, our other co-organizer, and to learn a lot from him at these opportunities. Just a few words about Nick and his work. He has been a leading behavioral finance researcher for years, and I even want to say decades, even though that makes us sound old, but it needs to be said. And I think he's particularly known for his deep thinking about the right way to model behavioral phenomena in a tractable way and to think really deeply about the implications of making certain behavioral assumptions in market setting, in settings where we have agents interact with each other. Much of this work has been on prospect theory, thinking about the implications of prospect theory in asset pricing and for financial markets. And he has, by the way, a wonderful piece reviewing 30 years of prospect theory, which I really enjoyed, and how he's pulling everything together. And I thought we can get more of that. We can't get, we don't only get prospect theory from him. How about we get all of behavioral finance over the last 4 decades from him, and including not only the history, but the future. And I couldn't be more pleased that he agreed to do it. I should say, and I do have some inside information on that from co-organizing Beam with him, that I know not only that he is fantastic in seeing the big picture and seeing the strands of the literature and pulling them together, but he is also, when we organize conferences together, a stern defender of conferences being devoted to the latest interesting research. So every year for Beam, we go through the same procedure. I try to put on some panels or some big picture lectures on where's behavioral macro going and shouldn't there be more behavioral in IO. And then Nick listens to all of that and says, how about we put 2 more exciting papers on the program? And that's typically what happens. And I do appreciate it. I think we only stay young and open to new directions if we see what's really going on in the field. But on the other hand, his views and big picture considerations are really important. And so now you know my secret agenda. I invited him to give this lecture. He couldn't dare to say no, and now we get to hear his view on how the field has been developing, where it's going, and what might be exciting new directions. So I couldn't be more thrilled that we have Nick as our speaker, and I would say the floor is yours.
So thank you, Ulrike, for that very generous introduction and for inviting me to give this talk. I first met Ulrike, I think, in 1998 when she was a graduate student at Harvard, and even then it was clear she was uniquely talented. So it's wonderful but not too surprising to see her reach the top of our profession and to be an amazing role model for what it means to be a successful academic doing meaningful work. And I'm sure many of you share my excitement about her being president-elect of the AFA, and I'm already looking forward to her presidential address next year. I want to thank you all for coming today. My topic is Behavioral Finance at 40, Progress, Open Questions, and New Directions. I'm going to try to do an informative and useful talk for you. I'm not going to talk for more than an hour, following which there'll be plenty of time for your questions, comments, thoughts, and reactions. So the modern era in behavioral finance, it began in the 1980s with the work of Robert Shiller on excess volatility, the work of de Bont and Thaler on long-run reversal. So today, 40 years later, I want to take stock of the field. I'm going to review some important frameworks we've developed in behavioral finance, identify some open questions, and also discuss a recent shift in the field. Some people are calling it the cognitive turn in behavioral economics. So for 25 years, we focused on making assumptions about beliefs and preferences, but in the past 5 years, we've tried to go a level deeper to focus on the foundations of those beliefs and preferences. And something about the style of the talk. So it's designed to be accessible to all finance scholars, regardless of area of specialty. Finance is now a huge field. Many of us inevitably specialize, so we're not always very familiar with what's happening in other areas of finance. I find that many people are interested in behavioral finance, but they're not sure what's really going on in the field. So this is 1 hour to sort of try to catch you up on important developments. And I hope the talk will be accessible even to some non-academics. There's so much excellent finance research, but I think we don't do a great job communicating it outside academia, so I'm going to try to make this accessible to some non-academics. And because of that, while the talk will be based on research that is often quite technical, the talk itself will be mostly non-technical, focusing on intuition. And behavioral finance has moved forward because of contributions of many scholars, so the talk is going to be based on the work of many researchers, certainly not just my own research. I will include some references along the way, but it won't be comprehensive because I don't want to clutter the slides. Instead, at the end, I'll just mention some readings where you can find a more comprehensive set of references. So I think you may know that behavioral finance has 3 main areas of application: asset pricing, corporate finance, and household finance. Today I'm going to focus more on asset pricing applications, not because that's the most important. These 3 areas of application are equally important, but because I think asset pricing is a context that really helps us identify and filter out the most important investor biases. Only biases that affect many investors in a correlated way have a chance of influencing asset prices. So in that sense, biases that affect asset prices must be particularly important. And since I'm going to focus on asset prices, why don't I try to lay out major frameworks today in behavioral asset pricing? This is what I picked out. First of all, limits to arbitrage, which says that rational people will have a hard time fully correcting mispricing caused by irrational people. Now, that creates space for the irrational people to affect prices, but to make progress, you really have to make some more assumptions, either about beliefs or preferences. So on the belief side, we have 3 frameworks. One that says if people disagree about the future prospects of an asset and there's short sale constraints, you're going to get overpricing. Another framework that says that people have irrational and specifically extrapolative beliefs about returns. And another framework that says they have irrational beliefs about cash flows. And on the preferences side, there's a framework that says we should model investors as deriving utility from gains and losses combined with some elements of prospect theory. And within behavioral finance, there's a view based on mounting evidence that these frameworks are central and first order for many important financial phenomena, perhaps as important, if not more important, than some of the rational mechanisms we know and love. And I'm going to try to begin convincing you of that today. Now, of these 5 frameworks, limits to arbitrage and disagreement are pretty well established. There hasn't really been much action in them in the past few years, so I'm not really going to talk about them. Instead, I'll focus on the other 3 frameworks marked with asterisks. So as I move to the roadmap for my talk today, I'm going to talk about beliefs about returns, beliefs about cash flows. On the preferences side, I'll say a few words about gain, loss, utility, and prospect theory, and then, as promised, I'll talk a little bit about the cognitive turn in behavioral economics, cognitive foundations of beliefs and preferences. That's the plan. So let's dive in. Beliefs about returns. So the most prominent idea regarding beliefs about returns is that they're extrapolative. So beliefs about future returns are a positive function of recent past returns. And this is incorrect because realized returns don't depend as positively on past returns as people think they do. So after good returns on an asset or asset class, people overestimate the future return. After bad returns on an asset or asset class, people underestimate the future return. And this is motivated in part by survey evidence. We do a lot of surveys of investors where we ask them for their beliefs about future returns. And what we find is, particularly for retail investors and some financial professionals, these beliefs are extrapolative. So here's a graph from Greenwood and Schleifer. This runs from 1996 to 2012. The red line is in each month we're asking investors, primarily retail investors, for their beliefs about the stock market return over the next year. And the blue line is at the very moment we asked them for their beliefs, what had the return on the stock market been the previous year? And you can see the positive relationship. If the stock market did well last year, people think it's going to do well next year. If it did poorly last year, people think it's going to do poorly next year. But these beliefs are incorrect because realized returns don't depend on past returns as positively as people think they do. So this return extrapolation, it's generated a lot of interest because it seems to offer a simple explanation for several prominent asset pricing puzzles like excess volatility and predictability in the aggregate stock market and other asset classes, for momentum and reversals in the cross-section, for bubbles. Let's take 2 minutes just to recall what the intuition is, and I'll just do this with the help of a very simple model. So imagine an economy with t+1 periods from time 0 to time capital T and 2 assets, a riskless asset with a constant return of 0 and a risky asset that's a claim to a single final cash flow, dt, at time capital T. And this dt, the final cash flow, it's equal to d0 plus a sequence of mean zero normally distributed shocks. So d0 is announced at time 0, so your expectation at time 0 of the final cash flow is d0. Epsilon 1 is announced at time 1, so your expectation at time 1 of the final cash flow is d0 plus epsilon 1, and so on. And some of the investors in the economy, they're extrapolators. They have extrapolative beliefs about price changes. So their expectations at time t about the future price change, which I'll call x, is just a weighted average of past price changes with weights on the past price changes that are positive and decline the further back you go in the past. So you can see the price changes on the right there. Theta is between 0 and 1, so that ensures that the weights are positive and decline the further back you go. And you couple that with a utility function to get an expression for the demand of these extrapolators. The other investors in the economy, let's call them fundamental traders, they just make sure that the price doesn't deviate too much from expected final cash flows. They'll buy if the price is low relative to the expected final cash flow. They'll sell if the price is high relative to the expected final cash flow. I don't include the equation for their demand here just to save some space, but you can find it along with other details of this simple model in the survey paper I drew this from. And then market clearing allows you to find equilibrium prices, so the price of the asset at time t is equal to the expected final cash flow at time t, dt, plus this extrapolative belief component weighted by the fraction of extrapolators in the economy minus a correction for the risk that you're taking. Okay, so how do prices behave in this model? Let's answer that with a simple picture. So the blue solid line in this picture shows you how the price of the risky asset behaves over 12 periods following a good cash flow shock at time 2. And the red dashed line shows you what you might call the fundamental value, which is the price of the asset if there were only fundamental traders in the economy. So what happens? Well, at time 2, when the good cash cash flow news comes out, of course, the fundamental value goes up sharply and then goes up at a slower rate. That's just the risk premium compensation for the risk that you're taking. What explains the shape of the blue line, the price in the presence of extrapolators? So it goes like this. Obviously, when the good cash flow news comes out at time 2, the price of the asset goes up. In the next period, the extrapolators look back, they see a positive price change. That makes them excited about future price changes, so they buy aggressively, pushing the price further up. In the next period, they look back and they see 2 periods of positive price changes. They get even more excited about the future. They buy even more, pushing the price even further up, and that can go on for another period. But then something important happens. Now the really good price change at time 2 associated with the good cash flow news, notice it has receded further into the past, therefore it receives less weight in your beliefs. So while remaining optimistic, you get a little bit less so, and the price comes down a bit. And now the extrapolators look back and they see a negative price change, so they get much less excited and the price comes down a lot. So notice for many parameter values, there's this sort of self-correcting property to models with return extrapolation. And just at an intuitive level, you can see all the applications I was talking about in this picture, right? By comparing the blue line to the red dashed line, you can see that extrapolative investors introduce excess volatility relative to fundamental value. You can see the time series predictability. Notice how the high prices at time 5 are followed by low returns subsequently. You can see momentum, right? Notice how the good return at time 2 is followed by another good return at time 3. You can see the long-run reversal. Notice how the good price change from time 1 to time 5 is followed by low returns after that. And if there's a lot of extrapolators in the economy and the cash flow shock at the start is particularly good, you're going to get sort of an amplified version of the blue line, which is going to look a bit like a bubble. And that's one of our main behavioral finance theories of bubbles. The bubbles are triggered by good cash flow news that pushes prices up. Those price changes are then amplified by extrapolators, generating a bubble. And now we have increasingly sophisticated models of return extrapolation, sort of formalizing this intuition I've just conveyed, but we can go further than these models. There's more to do. So all this is promising, but there's a lot of open questions. First of all, what is the source of this return extrapolation? And can knowledge of it deepen our understanding of the empirical facts? I'll come back to that. This parameter theta is very important, the relative weight you put on recent versus distant past returns when forming beliefs about the future. What value of theta is consistent with observed prices, and how can we justify this value? And just to show you the kinds of problems we can run into, if you're using this model to explain the aggregate stock market or to think about it, and you're trying to set theta by looking at survey data, well, in the survey data, remember, people's beliefs about next year's return is based on just the past year or two of market returns. So that means theta is low, which means you're going to get a price dividend ratio that's not very persistent, much less than with a persistence much lower than what it is in reality. You can see that, right? If your beliefs are based on just the past year of market returns, then your beliefs are changing all the time, and so is the price dividend ratio going to. So how can we resolve that? Does theta vary over time? And if so, why? Casella and Gulen show it does vary in booms. People's beliefs about the future seems to depend particularly on recent past returns. Why? More open questions. Are these return extrapolation models consistent with the facts about investor portfolios? Who are the investors who are actually trading according to these extrapolative beliefs? And on that note, remember that Giglio et al. Find that investors' holdings are relatively insensitive to their beliefs. So if you increase your forecast of the equity premium by 1%, from 3% to 4%, traditional models say you should increase the fraction of your wealth in the equity market by 10%, from 50% to 60%. But if you look at the data, people actually increase their allocation to equity only by 1%, from 50% to 51%. So how do we explain that? And does that mean that shifts in beliefs can actually affect holdings enough to move prices? And finally, and this may sound a little provocative, but I mean it seriously, is this investor really about beliefs at all? Or does it reflect a different non-belief mechanism? Because you could get all of these applications just by specifying demand as a function of past return. You don't need to involve beliefs. What could such a mechanism be? It could be observational learning, a deep algorithm we all have inside of ourselves that says if you see someone doing an activity that is being rewarded, then you should do it too. So when you see the stock market go up, that tells you lots of people are being rewarded for investing in the stock market, so you should invest in the stock market too. That's a non-belief way of getting the same kinds of results. And under that view, what we see in the surveys is just people rationalizing through their beliefs an action they've already decided to take for non-belief reasons. So there's a lot to think about. A couple more comments before I move on. Sources of return extrapolation. We don't really know, but there's a lot of proposals. Some are very psychological in nature. They attribute it to base rate neglect or representativeness, or maybe to an incorrect belief in a law of small numbers, where you think that even a small data set is going to reflect the properties of the underlying model that generated that data. Or maybe it's memory. I'll come back to that. Other stories focus more on boundedly rational inference about underlying fundamentals. So in the classic Hong and Stein story, when you see a good past price change, you infer that good news must be percolating through the investor population. You assume it's going to keep percolating through the investor population, and therefore the prices are going to keep rising in the future. So what's going on? There's no consensus. It might be a mix of all these things, or maybe it's another mechanism we haven't spent so much time on as yet. And the last thing on this before I move on to beliefs about cash flows is I think this work on return extrapolation intersects in an important way with research on experience effects as pioneered by Ulrike and Stefan Nagel. And remember, in this context, the idea would be that a person's demand for a risky asset is going to depend not just on a weighted average of all of the asset's past returns, but specifically on a weighted average of the asset's past returns that you have personally lived through. And they show in their classic paper that such a formulation can bring us closer to understanding not just investors' portfolio holdings, but also stock market prices. They have this very intriguing diagram, this one here, where the black line is showing you over several decades the price to earnings ratio of the stock market, and the gray bars beneath are showing you a proxy for what the price might be if people form their demand as a weighted average of the stock market returns they have personally experienced through their lifetime. So that seems very intriguing and promising and worth further investigation. All right, that's beliefs about returns. Let's move on to beliefs about cash flows. So another line of research argues that important pricing puzzles are due to incorrect cash flow forecasts that overreact to news. So the idea is when prices are low, it's because of excessively pessimistic forecasts of future earnings growth. When prices are high, it's due to excessively optimistic forecasts of future earnings growth. And most papers use analyst forecasts to provide evidence for this view. They focus particularly on forecasts about long-term earnings growth, LTG. And just to be clear on what the mechanism is here intuitively, it's quite simple, which is suppose there's good news, people overreact to that and form excessively optimistic forecasts of future earnings growth, and so push the price of the stock market up too high, but subsequently earnings growth is not as good as people forecasted. There's a negative forecast error, so prices fall, returns are low. That's the mechanism. And the point is there's mounting evidence to support this. Let's look first at the aggregate stock market. So Bordalo et al. In the JPE this year present several pieces of evidence supportive, consistent with this view. They find that the price to earnings ratio of the stock market is positively correlated with analysts' forecasts of aggregate long-term growth. In other words, when prices are high in the stock market, that is when analysts are forecasting very optimistic long-term growth into the future. But this LTG variable also predicts future market returns with a negative sign, moments where people are forecasting very high long-term growth into the future. Those moments are followed by poor returns in the stock market. And one clue as to why is that moments when people are forecasting high earnings growth into the future, subsequently earnings growth is not as good as forecasted. So there's a negative forecast error, perhaps causing those low returns. And you can see that in this picture. So the solid line here is this long-term growth forecast over the decades. The dashed line is the price-dividend ratio of the stock market, and the dotted line are subsequent returns. So you can see the positive correlation between long-term growth and the price-dividend ratio, but also the negative correlation, not just between the price-dividend ratio and subsequent returns, but between the long-term growth forecast and subsequent returns. And I think this is potentially very significant because for the past 3 decades, the field of asset pricing has basically said that price fluctuations in the stock market are largely about movements in discount rates, about the denominator of the present value formula. But this research suggests that that view might be wrong, and that movements in stock prices may be primarily about the numerator of the present value formula, in other words, about incorrect forecasts of future cash flows. So it seems to me that maybe we should begin shifting our views on this, and I'm very curious to see whether we will shift our views. Let's reconvene in 10 years and see where we are. I'm expecting a shift in views. You can do something similar at the individual stock level. So you can approximate the return on a stock as follows. The return on a stock between time t and t+1, it's roughly equal to Ri, which is compensation for the risk that you're taking, plus this term in square parentheses. It's an expectations term. So it's the dividend growth between time t and t+1, that's G, minus expected dividend growth, plus the change in expectations between time t and time t+1 about more distant dividend growth. And in a separate working paper, Bordalo et al. Compute the term in square parentheses using analyst forecasts of future earnings. They use earnings per share forecasts for 2 years out, and then long-term growth forecasts out to 5 years, and they convert these earnings growth expectations to dividend growth expectations using observed dividend payout ratios. And what do they find? They find that this expectations-based component can explain the entirety of the value and size anomalies and a substantial portion of the investment, profitability, and momentum anomalies. So, for example, the intuition is the reason why there's a high return on average to value stocks over the decades, it's due to people correcting up their overly pessimistic forecasts for the future earnings growth of those value stocks. And interestingly, this expectations approach not only explains the long-run average return of value stocks, but also the period-by-period returns. So in this chart over the decades, the black line is showing you the year-by-year returns on value stocks, and the red line is showing you that expectations-based component, and you can see a strong correlation between the two lines. So I think this too is very significant because for the past few decades, a significant portion of the asset pricing community has said quite firmly that the high average return to value stocks is compensation for risk. In other words, it's about the denominator of the present value formula. But it seems possible that that view is just wrong, and that really this is driven by the numerator of the present value formula, by incorrect forecasts of future cash flows. Once again, I think maybe our views should shift on this. So let's reconvene in 10 years and see where we are. Okay, moving towards open questions, the expectations that appear particularly helpful for understanding asset prices are these forecasts of long-term growth. And the evidence I just showed you strongly suggests that these long-term growth forecasts overreact to information. I say that because this long-term growth variable, it forecasts returns with a negative sign, both in the time series and in the cross-section. And you can actually confirm this overreaction directly by running those Koybongorodnichenko regressions of forecast error on forecast revision. They show overreaction in this LTG forecast, both at the individual and at the consensus level. But there's a lot of open questions here. Most fundamentally, what is the source of this overreaction? Why are people overreacting? That seems to me to be a very fundamental question in finance. We don't know. There's a bunch of proposals. Maybe it's something to do with representativeness, as in diagnostic expectations, or base rate neglect. Maybe it's some kind of incorrect belief in the law of small numbers. Maybe it's memory. Maybe it's something quite different. We don't know. It seems very important to dig into this. And maybe it will help to answer this question: which specific news are investors overreacting to? I'll come back to that. Also, while there is overreaction in these long-term growth forecasts, there's actually underreaction in forecasts of near-term earnings. So how does that all fit together? And finally, a question looming over this entire literature is it the cash flow expectations that are driving prices, or are prices driving the cash flow expectations? In other words, maybe prices are pushed up for some other reason, maybe preferences, and then when you ask analysts for their forecast of long-term growth, they just give you a number that fits the observed prices, even though those expectations are not actually driving prices. And Chowdhury puts forward this view, but there's pushback from the Bordalo et al. Papers. But in any case, what this suggests is it would be very helpful to dig more deeply into how exactly analysts are forming these expectations. So just a couple more things before moving on. On this question of which news investors are overreacting to, one view is that investors are overreacting to past tangible accounting information. For example, past earnings growth. Maybe when past earnings growth is good, people overreact and think future earnings growth will be very good. Now, the evidence on this is mixed. Nagel and Xu do find that a long-term weighted average of past fundamentals predicts stock market returns with a negative sign, so that suggests overreaction to those past fundamentals. Bordalo et al. Find that past earnings surprises lead to excessive revisions in consensus LTG forecasts, suggesting some overreaction to those earnings surprises. But in a famous older paper, Daniel and Titman find that growth in past fundamentals in the cross-section has no predictive power for returns, suggesting that people are not overreacting to past accounting information at the firm level. And that last finding in particular has led some researchers to argue that investors may not be overreacting so much to tangible accounting information as to intangible information, not so much overreacting to past earnings growth, but rather to news that the CEO is a charismatic person, something like that. And of course, this makes it harder to study overreaction because it's harder to measure the intangible information, but it's not impossible, and I hope we start trying to do that. And finally, on this topic, I've been talking a lot about overreaction in beliefs about cash flows and returns, but of course, some phenomena suggest underreaction, like, of course, classic post-earnings announcement drift. And more generally, whether you look at experiments, surveys, or markets, all of them display instances of both under and overreaction. So I sometimes like to summarize it in a table like this. If you look at experiments, there's experiments on so-called conservatism that demonstrate underreaction, but there's experiments on so-called representativeness or overconfidence or on time series forecasts that point to overreaction. If you look at surveys, it depends whether you're looking at individual level surveys or individual level forecasts, or consensus forecasts. If you're looking at the individual level, there's overreaction to a majority of economic variables, but not to all. There's actually underreaction when forecasting near-term earnings or interest rates. If you look at the consensus forecast, it's the opposite. You see underreaction for most economic variables, but overreaction for some, importantly, for long-term earnings growth. And if you look at markets, same thing. Price reaction to earnings news suggests underreaction, but excess volatility and the value premium suggest overreaction. And the challenge for us is to make sense of these six cells and to understand how they relate to one another. And there is real progress on this. So papers like Bordalo et al. In 2020, Augenblick, Lazarus Thaler, Barber and Imas, Kwon and Tang, all of them make nice contributions to this, but we have more to do to fully understand these six cells here. All right, so those were some comments about beliefs. First of all, beliefs about returns, and then beliefs about cash flows. Let's now say a word about preferences, and specifically about gain-loss utility and prospect theory. So traditional models assume that investors make decisions under risk according to the expected utility framework, but decades of laboratory research has found that expected utility is just not a very accurate description of choice under risk. And so there's many non-EU models that try to capture people's decisions more accurately. Prospect theory, due to Daniel Kahneman and Amos Tversky, is by far the most influential. A quick reminder of its 4 elements. First of all, reference dependence. People derive utility from gains and losses, a contrast to expected utility where the focus is instead on wealth levels or consumption levels. Loss aversion. People are much more sensitive to potential losses than to potential gains. That's usually modeled by a kink in the utility function at the point of zero gain. Diminishing sensitivity refers to the utility function being concave over gains, but convex over losses. Motivated by people being risk-averse over moderate probability gains, they do tend to prefer $500 to a 50% chance of 1,000. They like certain gains. But they're risk-seeking over moderate probability losses, preferring a 50% chance to lose 1,000 to losing $500 for sure. They don't like certain losses. And finally, probability weighting, which I think might be the most useful element actually for asset pricing. People weight outcomes not with objective probabilities, but rather with transform probabilities that overweight low probability outcomes. So the classic picture is this one, where the probability of an outcome is on the horizontal axis, and the vertical axis shows you the weight that the brain puts on that outcome when making a decision. And the 45-degree line is the expected utility benchmark. But what Kahneman and Tversky and others found in their experiments is that the weight the brain actually puts on these outcomes, depending on their probability, is given by that remarkable nonlinear solid line, that inverse S shape that in particular overweights low probability outcomes. And I think the best way for our purposes today to think about this is in terms of certainty equivalence. So think about a gamble where you could win $100 with probability 5%, and think about what your certainty equivalent for that gamble is. What amount of cash would make you indifferent between that cash amount and the opportunity to take this gamble? When we ask people that question, they typically give an answer higher than expected value, a number like $6, $7, $8, $9, $10. That's what's being captured here by this overweighting of low probability events. People are overweighting this small chance of getting $100, so they're excited about this gamble, and they state a certainty equivalent that's higher than expected value. So what does all of this mean for asset prices? Well, it's taken us many years to figure it out, but some things are now understood, and I just want to briefly share them with you. Let's start with the aggregate stock market. So a key assumption you have to make is, what are these gains and losses that people are thinking about? Here, the gains and losses are typically taken to be annual changes in financial wealth. And that's a significant assumption, not just in the focus on gains and losses, but also in the focus on financial wealth, because in traditional models, you focus on total wealth, including real estate and human capital. So the reason we're focusing on financial wealth here is that's the information you see when you log into your brokerage account. You see your financial wealth, not necessarily real estate and human capital as well. And here the robust prediction is prospect theory predicts a very substantial equity premium, perhaps helping us explain the high historical equity premium. This is due in part to loss aversion. If you invest a lot in the stock market, you're going to see big fluctuations in your financial wealth. Since you're loss averse, that's unpleasant, so you charge a high average return as compensation. But more subtle, but perhaps equally important, is a probability weighting component. And this is because the returns on the aggregate stock market are negatively skewed, as in the picture. The aggregate stock market is subject to occasional big crashes. So the effect of probability weighting is when you think about the stock market, you're overweighting the small chance of a market crash, so you find the stock market aversive and you charge an even higher average return. What about in the cross-section? So here we typically take the gains and losses to be gains and losses in the value of individual stock positions. That is an important assumption, but maybe not absolutely critical. If you instead define the gains and losses as changes in financial wealth, you'll get qualitatively similar results. And what you get here is prospect theory predicts that the average return on a stock will be determined not just by beta, but also by the stock's return volatility, including idiosyncratic volatility, the stock's return skewness, including idiosyncratic skewness, and the average capital gain or loss across the investors holding the stock, which is called the capital gain overhang. So in simple terms, the average return is going to be a positive function of volatility, negative function of skewness, and positive function of gain overhang. Why is this? Volatility matters due to loss aversion. If a stock is very volatile and you're sensitive to losses, you don't like that and you charge a high average return, all else equal. Skewness matters due to probability weighting. If you have a positively skewed stock, as here, the impact of probability weighting is to make you overweight those wonderful right tail outcomes, so you find this asset to be very attractive, you're willing to pay a high price, and to accept a low average return on the stock. And capital gain overhang matters due to diminishing sensitivity. Remember the idea that people like certain gains but do not like certain losses. And this is an important argument due to Grimblatt and Hahn. So on the left there, suppose that a stock has gone up, bringing its holders a gain. Well, then those investors want to sell the stock because then they can lock in a certain gain. You don't want to keep holding the stock because then you have an uncertain gain that's not as appealing. And because they want to sell, that depresses the stock price, causing it to be undervalued, and therefore its subsequent average return is higher. So notice this positive connection between capital gain overhang and subsequent average return. Similar argument if a stock goes down, bringing a loss to its holders. Well, in this case, those holders want to hold the stock or maybe buy more of it, because by continuing to take risk, they give themselves a chance to break even, which is very appealing. They don't want to sell because then you lock in a certain loss. That's no good. And because they're holding or buying more, that pushes the stock price further up from where it would normally be. The stock is overpriced, and therefore subsequent average return is lower. So in essence, people are willing to accept a lower average return in return for the opportunity to break even. And in work with Lawrence Jin and Baolian Wang, we show that a quantitative model based on this framework can help explain 14 of 23 prominent anomalies, including the volatility, distress, momentum, profitability, and issuance anomalies. And here's an example. This is the volatility anomaly. On the horizontal axis are the 10 volatility deciles from decile 1 to decile 10. Decile 1, low volatility stocks. Decile 10, high volatility stocks. And the red dashed line, those are the empirical alphas, showing you the very negative alphas for highly volatile stocks. And the blue solid line shows you the quantitative prediction of our model, showing it can capture a significant chunk of the volatility anomaly, including this non-linearity in alphas across deciles. What's going on? Focus on decile 10, the very volatile stocks. You've just got to put together the three forces I just mentioned. So decile 10 stocks, by definition, they're very volatile. So because of loss aversion, they need to have a high average return. But turns out they're also very positively skewed. So because of probability weighting, they need to have a low average return. And turns out these stocks also typically trade at a loss for their holders. So because of diminishing sensitivity, that also means they should have a low average return. So notice two forces pushing for a low average return, just one force pushing for a high average return. Overall, the model predicts a low average return for these stocks consistent with the data. And the model explains the 13 other anomalies in the same way. It explains the low returns on the stock in the low return deciles as being due to the fact that those stocks are very positively skewed and tend to trade at a loss for their holders. And one other thing that this framework can explain is the following puzzle, which is if you look across asset classes, the ones that are more volatile than like the stock market have a much higher average return than those that are less volatile, like T-bills. But if you look within the stock market, very volatile stocks actually have a lower average return than less volatile stocks. And in this framework, the key to understanding that is skewness. The point is that the aggregate stock market is negatively skewed, and therefore, because of probability weighting, can have a much higher average return than T-bills, but highly volatile stocks are positively skewed. So because of probability weighting, they can have a lower average return than less volatile stocks. So there's lots of open questions here too, including how does all of this fit with the stuff I talked about regarding beliefs? But the one open question I'll focus on, and I'll come back to later, is some of you may know that in the past few years, the elements of prospect theory are increasingly being seen as reduced form ways of capturing risk attitudes that are actually driven by deeper psychological forces. So for example, maybe with loss aversion, it's not literally that people are more sensitive to losses than to gains, although they may be some of that, but also it may be that gambles involving losses are more complex and people are averse to complexity. So what seems like sensitivity to losses is partly just complexity aversion. Or maybe with probability weighting, maybe it's not literally that people overweight low probability events, but rather that their attention is drawn by extreme payoffs, which tend to have a low probability. So what seems like overweighting of low probability events is actually attention to extreme payoffs. So this raises the question of how do we change our interpretation of all of these applications of prospect theory that we've worked on? How do we change the way that we model them? I think that's something we have to grapple with over the next decade. So if you remember, these are the 5 frameworks I outlined in terms of frameworks in behavioral asset pricing. There was limits to arbitrage, and then on the belief side, the disagreement framework, irrational beliefs about returns, and irrational beliefs about cash flows. And then on the preferences side, gain-loss utility and prospect theory. And 2 of these, remember, the first 2, there hasn't really been much action in the past 5 years, so I didn't talk about them. I talked about the other 3. And as I mentioned, in behavioral finance, there's a view, based on growing evidence, that these frameworks are really central and first order for understanding a bunch of important financial phenomena, and I hope I've begun to convince you of that. So in the remainder of my time, I'll go to my last topic, which is the cognitive turn in behavioral economics, cognitive foundations of beliefs and preferences. So for the past 30 years, we've tried to make sense of financial phenomena by applying the psychology of beliefs and preferences, high-level psychology studied by Kahneman, Tversky, and others. And I say high level because it pertains to high-level constructs like beliefs and preferences. But in the past 5 years, a new line of research has sought to understand the cognitive foundations of these beliefs and preferences. So in the minutes that remain, I'm going to review some of this research and comment on its potential. And there are several strands to this work on cognitive foundations that you might encounter. There's work on cognitive uncertainty or cognitive noise or variants of that, like efficient coding. There's work on memory. There's work on attention. There's work on complexity. There's work on reinforcement learning. I'm going to briefly talk about just 2 or 3 of these. And a diagram that might be helpful to you for structuring all of this is just this simple diagram. For the past 25 years, we've tried to make sense of individual decisions by making assumptions about beliefs and preferences, but now we're going one level deeper to try to understand the foundations of those beliefs and preferences in the hope that that will give us a better understanding of individual decisions. All right, so I'm going to talk about 2 or 3 of these just briefly. Let's start with cognitive uncertainty. What is this? It's a person's subjective uncertainty as to what decision is the right one or what belief is the correct one. So for decades, we've understood that There's noise in the external environment. If a company is very complex, then there's obviously noise in my forecast of its future cash flows. Cognitive uncertainty is instead noise that arises as part of the thinking process itself that's internal to the brain. So when making a decision, you don't know your true preferences. You struggle to combine utilities and probabilities. You imperfectly perceive the problem. Or when forming beliefs, you don't really know Bayes' rule. You have trouble implementing it. And in this situation, Enke and Graeber, building on a long line of research in psychology, propose that we can model someone's behavior as follows. They have a prior about the right action to take, a default action you would take in the absence of any deliberation. You then receive a noisy signal of the right action, and then you combine the two in a Bayesian fashion so that your action is a mix of your prior and of the noisy signal. So, a little bit more formally, suppose that the optimal action is A star theta, where theta is a payoff relevant parameter, for example, the probability of a payoff, and you have a prior about the right action, which is drawn from a normal distribution centered at this default action, AD. And then you get a noisy signal of the optimal action, S of theta, drawn from a normal distribution centered at the optimal action, A star of theta. And then in the usual way, the action chosen is just going to be a combination of the prior and of the signal. And the average action will be a combination of the default action and the optimal action. So the point is that this simple framework can provide a foundation for several aspects of beliefs and preferences. Let's look at a couple of examples, belief updating first, and then probability weighting. So in the 1960s, psychologists began to do lab studies to see how people update their beliefs. Here's a typical question they would ask people. If you haven't seen this before, you may like to mull it over. Imagine two urns. Urn A has 700 blue chips in it and 300 green chips. Urn B is the symmetric opposite. It has 300 blue chips in it and 700 green chips. One of the urns is chosen at random and 12 chips are drawn from it with replacement. Turns out 8 of them are blue and 4 are green. So the question we ask people is, what's the probability that the 12 chips were drawn from urn A? And if you haven't seen this before, you may like to briefly mull it over. Just try to sense where your intuition is taking you. So the answer is clearly greater than 0.5, and most people will give an answer in the range between 0.7 and 0.8, but the correct answer is actually 0.97. So this is an example where there's strong underreaction to the signal that of the 12 chips, 8 are blue and 4 are green. This is a finding known as conservatism in belief updating. But what is driving it? So the cognitive uncertainty view of this is that people are unsure what the right answer is because they're not quite sure how Bayes' rule works or how to implement it. And so what they're going to do is give you an answer that is a mix of a prior and a noisy signal of the correct answer. Here, a natural prior is 0.5 because that's the uninformative answer. So the answer you're going to give is going to be a mixture of 0.5 and a signal of the correct answer of 0.97. And that's what lands you in the 0.7 to 0.8 range. And Enke and Graeber provide some evidence for this view by running this updating experiment and recording people's cognitive uncertainty. Like they ask them, how confident are you of your answer? And finding that this conservatism is present mainly when people report significant cognitive uncertainty. But the interesting thing is the same framework can explain something seemingly very different, probability weighting. Remember again this idea that people weight outcomes not with objective probabilities, but rather with transform probabilities that overweight low probability outcomes. Remember again this graph where on the horizontal axis is the probability of an outcome and the vertical axis is the weight that the brain puts on that outcome when making a decision. You have this remarkable nonlinear solid line, the inverse S-shape, with the overweighting of low probability outcomes. Where is this coming from? So the cognitive uncertainty view is as follows. Again, let's think about it in terms of certainty equivalence. Let's go back to that gamble where you could get $100 with probability 5%. So you ask people for their certainty equivalent for that gamble. Well, they're unsure what their certainty equivalent is. And in that circumstance, what they're going to do is give you an answer that is a mix of a prior and a signal of their true certainty equivalent. So here the prior might be your certainty equivalent for a gamble that offers $100 with probability 0.5, say, because their probabilities don't play any role. Both of the payoffs, 0 and 100, have the same probability. And with linear utility, your certainty equivalent for that would be $50. And let's suppose your true certainty equivalent for the original gamble that gives you $100 with probability 5% is again $5 under linear utility. So their framework says you're going to give an answer that's somewhere between $5 and $50, hence explaining those higher numbers that people give, like $6, $7, $8, $9, $10. So if you want a kind of graphical version of that argument, it's like this. Imagine a gamble offering $100 with probability P. P is on the horizontal here, and people's stated certainty equivalent is on the vertical. Now, people might have a prior as to what their certainty equivalent is. That's the flat line. And their true certainty equivalent might be the 45-degree line under linear utility. But the point is, they're not quite sure what their certainty equivalent is, and therefore they give an answer that's a mix of the prior and of the 45-degree line, which means that line marks stated certainty equivalent, an upward sloping line with a slope less than 45 degrees. And if you squint at that, it's beginning to look like the Kahneman-Tversky probability weighting function with the overweighting of low probability outcomes. And Enke and Graeber provide some evidence for this view. They ask people for their certainty equivalent, but also for their cognitive uncertainty. How sure are you that that is your certainty equivalent? And they find much more probability weighting when people are exhibiting more cognitive uncertainty. Okay, great. But what does this mean for finance? Are there any lessons for finance? I think so. Here are some important implications. If cognitive uncertainty is in part what is driving probability weighting, then you can think of the financial applications of probability weighting as being at a deeper level driven by cognitive uncertainty. And by applications of probability weighting, I mean things like the overpricing of positively skewed assets, like volatile stocks or distressed stocks or IPOs or out-of-the-money options. And another important lesson is, under the cognitive uncertainty view, probability weighting and the preference for skewness it embodies is not a true preference. It's rather just a reflection of the brain's cognitive limits and the fact that there's cognitive noise that prevents you from really figuring out your true certainty equivalent. So what that means is that the buying of lottery-type assets is more of a mistake than we previously thought. Before, when we ascribed the buying of lottery-like assets to probability weighting, we weren't quite ready to call that a mistake because maybe people have a true strong preference for skewness that is being captured by probability weighting. But now we understand that that's not really a true preference for skewness. It's just coming out of the brain's cognitive limits. And therefore, the buying of lottery-like assets is more of a mistake than we thought. We should discourage it more than we did. And cognitive uncertainty, here's a separate lesson for finance, can offer us a deeper understanding of underreaction. So for 25, 30 years, we've associated the underreaction in post-earnings announcement drift with the evidence on conservatism in belief updating that I showed you a few minutes ago. But if we don't know what is driving the conservatism in belief updating, that doesn't really give us a real understanding of post-earnings announcement drift. So that's a bit disappointing. But now, if cognitive uncertainty is the root of conservatism, we now have a more concrete explanation for post-earnings announcement drift. And I guess the story would be when earnings news comes out and people are updating their beliefs, well, people struggle there. They're not sure about Bayes' rule, they're not quite sure how to implement it, and therefore they cling more to their prior views, and you have more underreaction. And a side note is about 25 years ago, Andre Schleifer, Rob Vishy, and I presented a model of under and overreaction that combined conservatism with representativeness, and I guess therefore a more modern treatment would replace conservatism with cognitive uncertainty. So a nice model of under and overreaction might be a mix of cognitive uncertainty and representativeness, and this has actually been explored by Boren and Emas, who find experimental support for it. But by the way, cognitive uncertainty, even on its own, may offer a nice model of both under and overreaction in the following sense. Every day we're exposed to all kinds of time series processes, right? And some of them have low persistence, some of them have high persistence. And it's hard for us to keep track of which ones have low persistence, which ones have high persistence. The cognitive uncertainty framework will say we will therefore forecast all processes as if they have moderate persistence. And what that means is we're going to overreact when forecasting low persistence processes like returns and earnings growth, and we're going to underreact when forecasting high persistence processes like earnings levels. And that's consistent with a lot of the available evidence. So that might be a nice way of thinking about a lot of the under and overreaction evidence. Do another example. Let's take a quick look at memory. So the idea is a deeper study of human memory may help us better understand investor beliefs about returns, say. So the broad idea is when people are forming beliefs about future returns, what they do is they first recall past returns, and then they simulate from the recalled returns to form expectations of future returns. Fine, but which past returns do people recall? So recent work by Zhang et al. Tries to answer this directly. They do a survey in China where they just ask investors right now, please recall some previous market episode without looking at past data. And what they find is people recall recent episodes and salient episodes. So you can see that in this picture from 1990 to 2022. The blue line is the Shanghai Composite Index, and the black bars are showing you the likelihood that that earlier episode was recalled. And you can see people are recalling recent episodes over there on the right, but also they're recalling the dramatic salient episodes in the market. Well, that seems reasonable enough, but it already has important implications. It offers a foundation for extrapolative beliefs about returns. Why do people overweight recent returns when forming beliefs about future returns? Well, if you form beliefs by recalling returns and then simulating, well, since you mainly recall recent returns, your beliefs are going to depend a lot on recent returns. It also suggests that our existing extrapolation and experience effect-based models of beliefs about returns may be incomplete, because the models we're using, they basically specify beliefs about returns as a weighted average of past returns, where the weight on past returns depends on how far back the return was and whether you experienced it or not. But what the evidence I just showed you suggests is the weight should also depend on how salient the episode was, and we've studied that much less. We can make additional progress by exploiting the large scientific literature on memory. So the literature on memory in psychology is complicated, but economists have found this book, Foundations of Human Memory by Michael Kahana, to be a useful gateway to it. And if you don't have time to read a book, there's a shorter survey paper you can read by Kahana, Diamond, and Aker, and they suggest that there are 5 laws of human memory. And aside from the law of recency, which we've already incorporated, the idea that people recall recent stuff, the law of similarity seems particularly promising. And the law of similarity says if there's an episode or event today that has particular features, then that's likely to trigger recall of earlier events or episodes with same features. And there's direct evidence for this in financial context. So Zhang et al. Find that if the return on the market recently was good, and you ask people to then recall another market episode, they're likely to recall another episode with good returns. Conversely, if the recent market return was bad, and you ask people to recall an earlier episode, they're likely to recall an earlier one with a bad return. Right away, this has implications. It further strengthens the memory-based foundations for extrapolative beliefs about returns. Because if you do form beliefs by recalling past returns and then simulating from that distribution, well then if after a good return that triggers recall of other episodes with good returns, well then your beliefs about future returns are very likely to be good. And it also suggests that dramatic past episodes are more likely to be recalled when currently experiencing a dramatic event. So if we're currently going through a crisis, we're quite likely to recall earlier crises, and that points to a mechanism of overreaction to dramatic news. If we're going through a crisis because everyone is then remembering all the earlier crises as well, we form a particularly negative view of the future, we overreact to current news. And there's work by Enke, Schwerter, and Zimmerman providing some experimental support for a mechanism like that. And much more briefly, let me say a couple of words about one last cognitive foundation, reinforcement learning. This is thought to be one of the brain's fundamental learning mechanisms. It says you should take an action that was rewarded the last time you took it, and don't take actions that were not rewarded the last time you tried them. And we've known about reinforcement learning for decades, but 3 developments make it perhaps ripe for use by economists today. There's emerging strong neural support for this learning mechanism. There are now computational models of reinforcement learning we can use. And perhaps most important, there are 4 frameworks being formulated that combine reinforcement learning with economists' more traditional belief-based models. Reinforcement learning on its own is too extreme a description of human behavior, but becomes more useful if you can combine it with our traditional belief-based frameworks, and that is now possible. So very briefly, what these reinforcement learning systems compute is a Q value, specifically what is QSA. It's the value of taking action A in state S today and then continuing optimally from the next period on. And how does the human brain compute this Q value? Through experience. You take an action A in state S and see what happens. If the reward is higher than expected, you increase your estimate of the Q value. If the reward is lower than expected, you decrease your estimate of the Q value through computational models like this. So your estimate of this Q value at time t plus 1 is your estimate of the Q value at time t plus a learning rate alpha times a quantity called the reward prediction error, which is basically how good is the reward you got relative to what you expected. So we can use models like this. Recently, Lawrence Jin and I have implemented this in the context of a simple portfolio allocation problem, and we showed it may help explain some investment behaviors like experience effects, because the reinforcement learning system, it emerges or it engages only when you're actually experiencing returns. So there's a special role to experienced returns. And it may also explain that puzzling insensitivity of allocations to beliefs, because in this framework, your allocations are determined in part by a reinforcement learning system that has no notion of beliefs. So it introduces a disconnect between actions and beliefs. So yet another example of how these deeper cognitive foundations may be helpful for understanding investor behavior. And let me sort of close here with some more general remarks about the benefits and challenges of this cognitive turn, and I'll be curious to hear your own reactions later. In terms of benefits, they're clear. It may offer a deeper understanding of several financial phenomena, for example, those associated with conservatism or with probability weighting, but I'm sure we can come up with many more examples. And these cognitive foundations also offer a way of unifying an otherwise scattered set of assumptions about beliefs and preferences. It can reconcile seemingly very different things like conservatism and probability weighting. But I think we should also be clear-eyed about the challenges here. The work on cognitive foundations has focused mainly on explaining beliefs and preferences, less on finance applications. So an exciting agenda is to try to link the cognitive foundations to financial applications. But let's be clear about the headwinds here. By nature, these foundations involve low-level psychology that is further removed from the applications in finance. Those things on the bottom row there, those cognitive foundations, it's low-level psychology. It's closer to the literal workings of the human brain. Almost by definition, that's further away from financial applications we're trying to explain. By contrast, it's easier to explain financial applications through assumptions about beliefs and preferences, because as soon as you make an assumption about beliefs and preferences, you have a prediction about individual behavior. But if all you're doing is making an assumption about memory or attention, you typically have further to go before you can make a prediction about behavior in financial markets. Also, this lower-level psychology, it certainly provides compelling foundations for beliefs and preferences, but the applications of the beliefs and preference assumptions are typically already known. So the low-level psychology, it can offer you a reinterpretation of these applications, but it would just be more exciting to come up with new applications or new predictions. So, for example, you could connect attention or memory to the probability weighting aspect of preferences, and since we already know the applications of probability weighting, you could reinterpret those as being about attention and memory. That's interesting, that's useful, but more exciting would be some new applications or predictions of those attention or memory assumptions. My other worry is that as we work on cognitive foundations, I do want us to try to remain disciplined. Some of you may remember that in the 1990s, behavioral finance was accused of being undisciplined. The critique was that any time there was any kind of puzzle in financial markets, what the behavioral finance people would do is reach for the psychology book on the shelf and flip through it until they found some kind of psychological bias that would seem to explain the puzzle they're trying to explain, and then declare victory and go home. And we were sort of stung by this critique, and we really made a concerted effort to stay disciplined. And I think that until about 5 years ago, behavioral finance was quite disciplined. I think the center of gravity in the field was in a small number of concepts like over-extrapolation and overconfidence and prospect theory. And I'd just like us to make sure that the influx of many lower-level cognitive concepts doesn't erode this discipline. To be honest, I think the field just will become less disciplined in the next few years because of the influx of these lower-level psychological concepts, but hopefully over time we'll figure out which the more useful ones are and focus on those and regain some discipline. And the last point I'll make here, a question that intrigues me, is does this cognitive turn in behavioral economics mean that we need to replace our models of investor behavior? In some cases, the answer is probably yes, and I'm excited to see what form that might take. But I would also say that even as we better understand these cognitive foundations, we might sometimes still want to work with reduced form models of beliefs and preferences. They're easier to work with, and they avoid taking a stand on which cognitive foundation is the right one. So, for example, return extrapolation. We now have 5 or 6 different possible foundations for that. Do we want a model that explicitly models those 5 or 6 possible foundations? Maybe, but that's going to be very messy and intractable. It may just be simpler to work with the reduced form. Or we now have 5 or 6 possible foundations for the probability weighting aspect of prospect theory. Do we want a model that explicitly models those 5 or 6 foundations? Maybe, but I think that's going to be quite messy and intractable. In many cases, it may just be simpler to work with the reduced form probability as captured by prospect theory. This is something we have to figure out. All right, so returning to my roadmap, I think I've covered my assignment for today. I talked about beliefs about returns and beliefs about cash flows. On the preferences side, I talked about gain, loss, utility, and prospect theory, and I gave you some thoughts on the cognitive turn in behavioral economics. And so to conclude, I've been following this field for about 30 years now, and I really feel that the field is as vibrant as ever, and I feel that there's mounting evidence that behavioral finance mechanisms are central to many important financial phenomena, and I'm seeing more high-quality research in the area than ever before. I see the outlook as promising for research on all 3 areas of application: asset prices, household finance, and corporate finance, and for research on both beliefs and preferences, with cognitive foundations playing an additional useful role as well. Despite the progress, I think we have a long way to go, and I've tried to signal that there's many important open questions for us to think about. And I mentioned at the start that I find many people are interested in behavioral finance, but they're not quite sure what's going on in the field. I hope I've been able to catch you up a little bit on some developments over the past hour. Here are some additional resources that might be helpful to you. I recommend the Handbook of Behavioral Economics, which has 3 chapters on behavioral finance, 1 on asset prices, 1 on household finance, and 1 on corporate finance. A few years ago, Ulrike and I produced about 10 hours of video lectures on behavioral finance, and I think some of that is still useful. It's available for free online as part of the AEA continuing education. In terms of summer schools for graduate students, we do a summer school in behavioral finance at Yale. And in terms of the latest research at conferences, there's the NBR Behavioral Finance meeting. It's true for capacity reasons, it's invitation only. However, it is live streamed on YouTube, and videos of the meetings are saved on the YouTube site for at least a week or two. So the presentations and discussions are really available for anyone who is interested. So I want to thank Ulrike once again for inviting me. I want to thank you all for your interest and your attention. I'm very curious to hear your questions, thoughts, comments, reactions, feedback. I'm going to stop there. Thank you.
Well, thank you so much, Nick. I don't know how you managed to squeeze all of this overview and the strands of literature, including the future, into 1 hour, without overwhelming us and making all sound smooth and hanging together. I think this was a lot for all of us to digest, but also very inspiring in terms of thinking what might come next. As we said in the beginning, we do have some time for questions, and I'm very happy that people have started lining up. Think of your questions. There are the 2 microphones, and let's take advantage of having Nick with us for another hour. Please go ahead.
Nick, thank you very much for your lecture. Really appreciate it very much. I'd like to take you to VIX, the implied volatility on the S&P 500, which, as you know, is typically elevated during a crisis. Would behavioral finance indicate that a higher VIX is followed by a higher expected return?
I think this is a very reasonable question, but I think I'm going to have to say I'm not instantly recalling research on that. So let me write your question down, think about it, and perhaps I may even be able to get back to you another time with an answer. I apologize, nothing's coming to mind right now. And by the way, I'll add, if you have questions for Ulrike as well, don't hesitate to ask them.
No, that's not
and Ulrike should also feel welcome to answer some of these questions. And by the way, we have some wonderfully distinguished people in the room. You shouldn't hesitate to answer some of these questions as well. Please feel welcome.
He's even smarter than I thought. But all right, let's think whether there are more questions for Nick. I think somebody else is there.
Hi, my name's Juan. Thank you so much for the great lectures, including the one in the morning. So my question is about, like, when you mention this cognitive term, you seem to use it as a reason behind the belief, so it will eventually change the belief. I'm thinking about, like, how about, like, other cognitive factor that may directly affect the decision making. So one example is I'm working on a paper to look at the contrast effect in financial analysts. I noticed that there is a twin version of contrast effect, which is the law of small number, or Barberis fallacy. And that would change in the belief level. But when I think about the contrast effect, it's more like perception level. And when I think about how to model it, so the belief, you will just affect the probability weighting, right? But how to model the contrast effect in terms of perception. So I wonder whether you have any thoughts on that.
Yeah, I think that could be an example of cognitive foundations. There it's about the psychology of perception, and there's a contrast effect which affects how we perceive this item in a sequence relative to the ones we saw before. To be honest, while there are some nice empirical papers on contrast effects, I'm much less familiar with ways of modeling that. But it seems to me it could very much be part of this cognitive foundations agenda, but not one that has received so much modeling or theoretical attention to date, but definitely worth pursuing.
I see. Thank you very much.
Oh, sorry, I didn't see that. Somebody on the left, maybe let's have them first.
That's okay, so you can go first.
Your question next. Yeah, go ahead.
Okay. So Nick, thank you very much. Nice summary. And I really appreciate your attention to cognitive foundations. But your criticism at the end made me remember the criticism level to us economists going to neuroscience 20 years ago on, well, we really don't need all this because after all, we already know from behavior that people have prospect theoretic preferences, etc. But you yourself said that we actually learned something fundamental about this, which is that prospect theory is not a theory of preferences. It's a theory of behavior. And we start realizing that actually most of this is mistakes. People really don't want to have prospect theoretic preferences. This is an extremely important message to the industry out there, because in the financial industry, in investments, there are funds there that use prospect theory to come up with the right investments for people, whereas you're basically giving in on people's biases, right? So that's my first comment on that. So, and then I appreciate what you said about the end, that we really need to find new predictions from the cognitive foundations that actually would bring us a little bit further. As you know, I've been doing neuroscience for 20 years now. I don't immediately see it work, because economists have been extremely good at squeezing everything out of the behavioral lemon. There is a bias, though, that I see in applications of the theory of cognitive limitations or cognitive foundations in neuroscience and in psychology, when I see this in economics. And it is very nicely illustrated with two examples of it. One is optimal inattention, and the other one is the Encke-Graeber theory that you mentioned. Right, so let's talk about Encke-Graeber. The reason why people don't show confidence, they call this cognitive, they show cognitive uncertainty, is because it's very hard to figure out what Bayes' law is, right? Yet they resolve that by a model that uses Bayes' law itself. It's a bit like optimal inattention. I can't pay attention to everything, so what I'm going to do is I'm going to decide what not to pay attention to. And it turns out that's an NP hard problem. And I don't have to remind you that this basically is an intractable problem. Yeah. So I must admit that actually in computational neuroscience and in mathematical psychology, people are a little more careful about not replacing one problem with another problem. And so maybe it's actually for the people who are interested in the audience here to do something about cognitive foundations in economics, to really think about that aspect of it, and what the neuroscientists and the psychologists have done in that field, because this is an extremely rich field, and look at, for instance, in optimal inattention, how you solve these problems, not with utility maximization, but with information theoretic approaches.
Yeah.
That's basically my comment. I mean, it's not a question. It's I just.
No, I find that perspective very helpful, Peter. Thank you. And thank you for sharing it. And I think I agree with everything you said. I'll just sort of reiterate, people looking at the field today might say, oh, the work on belief seems to be much more vibrant. But actually, on the preference side, there's a lot kind of bubbling beneath the surface because of this deeper understanding of prospect theory and its foundations, that it might not be a true preference. So I think that is ripe for a lot of work and rethinking. So I find it in some ways to be just as promising as the work on beliefs. There's a lot to be thought about. Thank you.
Thanks, Peter. John?
Nick, thanks for an amazing lecture. I just wanted to throw out two questions that kind of came into my mind during your talk and see what you have to say about them. So question number one is, when should we insist that beliefs respect identities? And when can we think perhaps people just don't understand the identities and don't discipline their beliefs that way? That came into my mind because you treated the extrapolation of returns and the extrapolation of cash flows completely separately, as if they were sort of separate things. But if you observe the price and you take a long enough view and rule out bubbles, those two things are linked by an identity. If you're optimistic about returns and the price is high, you must be super optimistic about cash flows. And so they can't be independent. But maybe they are, because maybe people don't understand the identity or build it into their belief formation process. So I'd love to know what you think about that. Second question, sort of stepping back even further, should behavioral finance be thinking about when people even form beliefs? There are lots of cases where I may not have a belief about something. I may simply delegate a decision. I rode in a Waymo driverless taxi last night. I didn't have any belief about how to drive, where to go. I got in the taxi, it took me where I wanted to go. And It seems to me a lot of behavioral finance assumes a sort of traditional structure by which you're an investor, you form a belief, you take a decision, you do all that. But why don't we delegate these decisions? It must have something to do with trust and who we trust or what we trust. But we are living in an era where, artificial intelligence is coming in. There's a lot more capability out there. Maybe the idea that human beliefs are central is already outdated. What do you think of that?
John always asks the tough questions. I mainly noted these questions down for further thought, but I like both of them very much. On the first question, I think John is absolutely right. We have to think about possible connections between beliefs about returns and cash flows, and I didn't really do that in my talk. To some extent, I feel it's sort of an empirical issue. Maybe we can dig into whether these things are related in the way they should be according to identities. But I guess I do have the radical view that sometimes people may not be aware of these identities. They may not respect them in their beliefs. I'm sort of open to that possibility. Perhaps that's being a bit too radical, but I'm open to that possibility. Let's see what the data say. And I also like the question on, when do we actually form beliefs? When might we want to delegate instead? Does that relate to issues of trust? I like that question. I was initially going to go in a different direction there, which is, I do think that sometimes we sort of insist too much that people do form beliefs when maybe they don't. And what I mean by that is, it seems to me there's a lot of algorithms that people use that are not necessarily belief related that guide their behavior. I gave the example of reinforcement learning. You just do stuff that has worked for you in the past. No belief involved. Or observational learning. I'm just going to do whatever I see is rewarding for other people. No beliefs really involved. And I think there's much more of that than we really have admitted so far in behavioral science. But thank you for the questions. I've noted them down. We'll think more about.
Can I ask a quick follow-up on that? How do you think about, thinking about your future perspectives and the maybe more radical steps which may come from some of these cognitive science foundations? So if we go into a more model-free or less model space, if we go towards maybe sometimes we don't have beliefs at all, sometimes we assume there's just a kind of a certain mechanism we follow which kind of goes against everything we learn from Econ 1 on. Like, what do you think for people interested in that and fascinated by these notions, how to discipline how we move forward? Because I think, as we have discussed, sometimes there's this risk when you learn something like similar to neuroscience coming into finance, that it's quite a bit away, it's quite a bit different maybe from what we have been doing. You don't want to be, get lost in a rabbit hole, fully fascinated by what, in your case, cognitive science has to offer. So when is it right to jump? What disciplines around? How does it remain relevant to economics? I think some of the neurofinance, neuroecon people have kind of said, well, ex-post maybe we would have been wanted to be more closely guided by predicting certain economic outcomes. Could you share your thoughts on that?
No, very reasonable. I think I'm just going to give a simple answer, which is I really do think we have to dig carefully into the psychology and make sure that we trust it. Because as we know, there has been this replication crisis in some areas of psychology. Some of these results you just can't rely on. We've been so lucky that, Dick Thaler pointed us a long time ago to the work of Kahneman and Tversky, and that was an inspired idea because those guys' work turned out to be very, very robust. And how fortunate, because all of modern behavioral economics largely is based on that work. Imagine if their work had not been robust, the field would have crumbled completely. So I just think we have to be careful. And with things like reinforcement learning, the good news is there is very careful work done on that by top people. But you do need to put in the time to really ask yourself, do I believe this psychology research? I think that's an important step. You can't just take it at face value.
Yeah, that's a good point, because something is so fascinating, you just want to use it, but pause and be critical. Sorry, letting you stand. Next question, please.
Thank you for a fantastic talk. Your focus has been on individual behavioral biases and the cognitive turn thereof. Living in a foreign country for 11 years, I was wondering if there are social behavioral biases. And are two brains behave differently when there are two brains or three brains instead of just one brain individually?
Absolutely. And so this is the issue of group biases. And a very brief anecdote is a few years ago, I was invited by Goldman Sachs Asset Management Division to give a talk to their clients. They wanted something about behavioral finance, so they asked me for possible topics, and I gave them my, favorite topics. I can talk about extrapolation, I can talk about probability weighting, and so on. And their response was, no, we don't want any of that. We want you to talk about group decision-making biases. That was actually their what they considered most important. And those of you who work in this space will know one reason why. It's because of the importance of investment committees in the asset management world. So these investment committees, very powerful group decision-making bodies, but which are thought to be often quite dysfunctional because of group decision-making biases. So they wanted to hear about things like conformity bias or obedience or groupthink, cognitive dissonance, things like that. And it's true that we focus on these things much less in behavioral finance, and it might be for some not so great reasons, which is we don't have really great mathematical models of these things, and we prefer to have mathematical models. So for some reason, we haven't studied those as much. But we should if we can. And I'm happy to see an increasing number of papers on group decision-making biases.
Thank you.
Mass psychology also, yeah. Next question, bitte.
Hi, Nick. I find your discussion about cognitive uncertainty as a driver of preference to be extremely intriguing. So under that framework, can we understand the time variation in risk aversion to be driven, in fact, by cognitive uncertainty? If that's the case, a lot of phenomenon that used to be explained by traditional classic model using time variation in risk aversion now, in fact, belong to behavior.
That could be, but I think we have a lot more work to do before we can get there. I mean, if you think that, if you can come up with some cognitive uncertainty, as we said, could be a driver of probability weighting, which in turn can determine risk aversion. And so if cognitive uncertainty varies over time, then probability weighting may vary, so you get changes in risk aversion. That is a conceptual possibility, but we've got to do a lot more work before we can say that that is really what's going on. We have to sort of try to measure time variation in cognitive uncertainty and so on. But in principle, yes.
Thank you for the lecture. It was excellent. I wanted to see if you can share your ideas about one specific, I guess, discrepancy or a puzzle. There's a lot of work done in the area of the presidential puzzle, where stock returns and GDP growth have been shown to be lower during Republican presidencies. But if you look at the polls and consistent perceptions of population regarding how does the economy and firms do during presidencies, generally the perception is that the economy does better under Republican presidencies, which goes against multiple, I would say maybe over 30 papers published that all consistently show across multiple periods to point to the opposite in both stock returns and economics indicators.
Thank you for raising the question. It's an interesting and very reasonable question. I apologize. It's not something that I have spent a lot of time looking at, but it's a very reasonable and interesting issue. So I'd rather not say too much on it because I don't have much to go on, but I'm glad you brought it up. I'll look into it and see if I can think of something.
Great. Any other thoughts, questions, challenges? Yes, please go ahead.
Hi, Nick. Thank you for a great, quick overview of these topics. So I was basically interested in prospect theory for the most part, and I followed a bunch of your papers over the decades about this topic. So, so as this talk has been kind of, structured in terms of decision-making, preference and beliefs, and then a lot of newer concepts like cognitives, memory, and all of that stuff. But
can you maybe lower your microphone a little bit?
Yeah, sorry about that. So
Yeah.
But my kind of question is that, so is there more to kind of explore in the zone of prospect theory? So maybe a little bit more specifics, stuff motivated from Kahneman and Teller had a lot of experimental counterparts in the last few decades, and then there's some of those theoretical counterparts which take some elements of prospect theory, some of your theoretical works are kind of like that, and then the very recent papers on how it explains a lot of these anomalies, right? So what other sort of areas do you feel is there in terms of some empirical counterparts of prospect theory, and especially how do we kind of link, say, for an empiricist specifically, the experimental stuff and the theoretical stuff, and do we just stop the literature here kind of there, or move into like the new, like more unstructured things, as you kind of say, or is there still more things that has like, some direction or something that has not yet been done from your thoughts? Like, because most of your work is kind of theory and you have some literature kind of stuff in your website, but then there's other people who just basically have like a bunch of experiments with like people who are not like subjects who are not like, in the financial markets per se. So what's your take and thoughts on this?
No, for sure there's more to be done at the sort of higher level. There are other areas to explore. We've focused a lot on the aggregate stock market, the cross-section, but what about other markets like the options market, for example? We could do more in terms of this individual portfolio choice. We could try and provide more evidence that it's really prospect theory that's driving something rather than something else. But I confess that what I'm most engaged with now is, what does this whole cognitive foundations revolution, what does that mean? If we're reinterpreting loss aversion, we're reinterpreting probability weighting, what does this mean? Do we need to start modeling things differently? Or does that suggest new predictions? That might be an interesting angle. So if the foundations of these elements of prospect theory are these deeper things, does that suggest some new predictions we could test? So that's the part that I'm more engaged with. But I'm not ruling out other kinds of work as well.
All right, thank you.
Right. Any more questions in the audience? Well, if not, then let's thank Nick Barberis again for a fantastic lecture. Thank you so much for doing this.